Good afternoon, everybody, and welcome to the 2012 year-end results for Redefine International Properties Limited. And I will use the acronym RIN to talk about Redefine International. And Redefine International PLC, which is listed on the London Stock Exchange, I will use the acronym PLC. Just to start off with, we set out our vision last year. And I think 2 out of the 3 we a long way along the line to meet, and that is to be the leading diversified mid-cap cash flow focused property investment company dual listed on the LSE and the JSE. Through our diversification strategy to provide industry leading hard currency income returns to unit holders. I think we're doing that at the moment very well, and we hope to continue to do so. And lastly, to develop a transparent and simplified corporate structure, including the possible conversion to a UK REIT or indeed a South African REIT if that makes more sense. The highlights for this year is that we met our earnings forecast that we set out last year in 2011. We successfully restructured and repaid over 250 million of legacy debt. More of that I'll talk about as we go through, largely the debt we took on when we merged with Whitchford. We had a very strong performance from the hotels and Cromwell. We have integrated the Whitchford business into our business, and that's gone very, very well, and it's settled down into a very well-functioning setup in London. We have made numerous disposals and asset management activities, which will enhance the overall portfolio quality. And we've got some development projects underway, more of which I'll talk about during the presentation. And then lastly, the capital raise, which was highly successful, where we raised over 1 billion rand in South Africa, which translated to 75 million pounds, and a further 60 odd million pounds in the UK for a total of about 127 million. The highlights from a headline point of view, the operating side, quite flat really. The occupancy dropped slightly. Indexation, which you call escalation in South Africa, improved, which was good to see. And our weighted average unexpired lease term has dropped marginally, but is still very strong at over 8.5 years. On the financial side, the distributable earnings that we have increased 20% to 18.2 million. The headline earnings per unit increased 12.5%, and distributable earnings per unit, and because we then distribute all our earnings, the numbers are the same at 4.38p, and that was 6.6% up for the year. Net asset value was an area where we dropped, and I'll take you through the reasons for that, due mainly to the valuation declines in the old Whitchford portfolio. Looking at it in rand terms, headline earnings per linked unit were 19% up at just under 96 cents. We had 2 distributions in the year, the first one at 26.8, the second one at 32, which will be paid on the 3rd of December. That's been forward fixed at a rate of 14 to the pound, 14 rand to the pound, which gives us the total distribution for the year of 58.9 or 21% up on last year. The fully adjusted net asset value per unit is 5.07 rand. And if we take into account that we issued our new units in the capital raise at 4.60 rand, we now have a pro forma post-capital raise NAV of 4.91 rand, which is a dilution of 3.2%. Distributable earnings, that just sets out how we get from our rental to the bottom line of 4.38, and it gives you the breakdown of the various bits and pieces that make up the income statement. As I said earlier, the portfolio valuation is where we've seen a decline, largely in 2 areas. The first one, what we call our UK stable income, and that's largely the Whitchford portfolio made up of UK government-let offices, and we had a valuation decline there of about 10.7%. A lot of the valuation decline is in the 2 funding facilities that we have, one called Gamma and the other called Delta. It's in negative equity, which means because it's of a non-recourse nature, we'll never have to put the equity in, but until we dispose of those properties, we have to carry it on our balance sheet, and that's why we're seeing such a large decline in the net asset value. The UK retail side, well, this silo business segment of the portfolio was the one that we had the most trouble with during the year. Certainly it's been well documented about the troubles of UK retail and specifically administrations of a large number of UK retailers. We believe we're over the worst, and the 9.4% drop there is part rental decline and part cap rate on the yield side, net initial yield. The European portfolio, effectively in sterling terms, it dropped 7.1%, but that's largely because the euro dropped against sterling, and the real drop on the European side in euros was approximately 1.7%. So you've got a 7.1% drop, but remember you've also got a drop on the other side with your debt, so the two almost balance each other out, and you've got a 1.7% drop overall. Hotels were constant, good performance from hotels, and Cromwell, exactly the same thing. The Australian dollar weakened against sterling, and that's why you got a slight drop of 0.4%. The good news on Cromwell, as I'm sure you know, is that post year end, we've had a further increase in the share price of about 10%, which takes you up another 10 odd million pounds. And just to show you how the balance sheet is made up with our net asset value per share, you'll see in the block there, I've got the two items highlighted called VBG negative equity. That was one of our facilities that we restructured post year end, and Delta also, those have been added back. Then just moving on to the capital raise, we had a very, very successful capital raise. And on the South African side, we had the RIN pro rata issue of units for cash, where we issued 218 million new units at R4.60. 1 billion rand was raised, and we were fortuitous that we were able to fix the rate at which we took the money out into the UK at R13.31. The rand dropped about 10% about a week after that, so it was very fortunate. So that meant £75 million was raised, and it was good to see we had a 94.9% take-up, and in fact with excess applications and selling down part of the redefined stake, it was diluted to 49 point. Unfortunately, a slight error has crept in here. It's 49.3, not 49.8. So I just need to point that out. Moving to London, on the PLC side, a total of 127.5 was raised. 104 million from the open offer, which was taken up 96.4%, which was very, very good news. We were concerned about the minorities in London, which meant the firm placement element of 23.2 million had to be increased slightly by 3.75 to take up the slack between the portion that took up the open offer. In that process, RIN was diluted to 65.7%, which means the shareholder spread on the London Stock Exchange has increased quite nicely to 35%, which is good news for liquidity and for spread purposes. And in the process, we've broadened the share register, and we now have some very large UK institutional investors on our share register, which is excellent news. The group structure, as you can see, we've got in the red corner Redefine Properties at what should be 49.3%, which owns Redefine RIN on the JSE, which in turn owns PLC. Your minorities there are split about a third in the UK, a third in South Africa, if you do it on a look-through basis, and Redefine owns approximately a third of the PLC. Use of proceeds, I've split this into three parts. The completed transactions, which has taken up about 53 million. The agreed transactions, about 16. And then potential transactions, I'm sure you've spoken about the Cromwell potential rights issue, which is a possible investment. And then we have Gamma restructuring, where we could well see ourselves acquiring some of the assets out of that facility. And then lastly, we're looking to restructure or put money into a new shopping centre in the UK, and in total that comes to about 60 million. On the operational side, the slides are all in the booklets, and the information is on the website for those that would like to look at it on the website. And just to confirm that we have 5 silos in our business. UK stable income, which is largely the government office portfolio. The UK retail side, which is our shopping centres in the UK. We've got Europe, which consists largely of retail and the VBG portfolio, which is a government-let office portfolio in Germany. Our hotel portfolio is based in London, and the Cromwell Property Group in Australia, in which we have 23.08% stake. Each one of these is set out in the document and will be on the website. And really, we've just set out there what's happened in terms of the operational side, the asset management side, how many leases we've signed, and what the void rates are. So UK stable income, other than the valuation decline, is going fine, and certainly the UK government does pay its rent. On the UK retail side, although it has been a tough half year, the occupancy has increased. We've signed 31 new leases, which total 125,000 square feet, and that takes into account the 90,000 square feet of leases that expired. Europe, we're close to 100% occupancy, which is very good. We've got long leases with the discount retail store sector, and we had 7 lease extensions, 3 store expansions, and 2 full renovations. The other interesting thing is we've tied up with Menorah, one of Israel's major pension funds, which is a big coup for us and for our team in Germany, and they helped us with the VBG restructuring, and we look forward to a long relationship with Menorah going forward. On the hotel side, the Olympics was very, very good for us. We were worried about post-Olympic slowdown. That hasn't happened. It's gone from strength to strength, and we're looking forward to a very, very good year going forward, and hope to expand and to grow that portfolio by acquisition. And then Cromwell, again, a very good investment for us, well managed, well run, and has given us superior returns. And certainly the share price in Australia is reflecting that, where the current share price is trading at around about 84 cents. And that shows a graph of Cromwell relative to the Australian index. As I said earlier on, we've got some development projects that we're looking at right now. The biggest one is in Harrow, where we recently had a rezoning application passed, and we're hoping to get on site there to build out this 316,000 square foot mixed-use scheme with a JV partner in the middle of next year. Our Birchwood Warrington redevelopment, we finished the first phase, and we're hoping to be fully complete by the middle of 2013. And then St George's Harrow, our big shopping centre in London, we had planning for 2 new restaurants, and we've got 2 operators that we signed up there, well known in South Africa, international operators. And in Croydon, and that's next to the Hammerson Westfield massive redevelopment precinct, we've got a building that we're looking to convert to a hotel and residential. And then on the various government-led offices, there is potential when the leases expire to convert to residential or to retail, and we're looking at many of those to start the process to get the ball rolling to convert those when the government vacates. Our lease expiry profile, you can see it's very smooth except for 2018, where we have a number of expiries on the government side in Delta and Gamma, and hopefully in the restructuring process we'll actually move those buildings out, and we'll lose the expiry profile problem that we've got, the hurdle in 2018. Other than that, it's a very smooth expiry profile for the next 10 years. And just to confirm, the facilities that we restructured or repaid in the last half year, coming to 254 million, VBG, Aviva, Delta, Gamma, and also we sold Halle in Germany for 37.1 million and took all that debt off the balance sheet. Our debt maturity now is a lot better than it was a year ago, where we've got a smooth expiry for the next 5-6 years, and then a big expiry of 270 odd million in 2022 plus. A lot of that is the Aviva debt, which is all 25-year debt, expires closer to 2030. So a very, very good expiry profile there. The road ahead, well, as I said, we've got a 5.07 Rand net asset value against the current share price of about 5 Rand. The forward earnings per unit, we were forced look to disclose to the JSE, and I've taken the mid-range here of what you disclosed in our results presentation yesterday of 3.2p. That's not a forecast, it's just the disclosure. But if you take that at 14 to the pound, you're coming out at just under 45 cents per unit going forward. The current yield, and I've used the RIN C, the convertible unit, which doesn't have the current distribution in it, the current yield, forward yield is about 9%. And our pro forma loan to value now, which is really what the key issue is for us, having reduced our debt, is sitting at just over 50%. So what lessons have we learned? Well, I think the key one for me is that Witchford deal was expensive. In retrospect, we didn't realize, or we didn't think the office market the regional office market would drop as much as it has. In any event, we did get cash and ungeared property to the extent that when we merged the deal. So we didn't overpay, we just didn't get what we thought we might get down the line in terms of added value. Gearing has a significant negative impact, as you can see, in a deflationary environment. So where values are going backwards and you have gearing, it's a multiple effect. It's a double whammy. But income is and always will be king, and our portfolio is very, very strong on the income side, and that stood us in good stead. And I think what we have to be very careful about right now is there are a lot of properties on the market. A lot of banks are getting rid of their properties. A lot of companies are insolvent. But you have to be very, very careful what you buy, because not everything that's cheap is a bargain. Having said that, though, notwithstanding a very difficult period, we've met all our forecasts since we listed. We've paid all distributions in cash. And our portfolio sale of those properties that we still own in negative equity is probably the route we're going to have going forward. But if I summarize everything, since listing, we've had a total return, if you held onto your shares, adding back the dividend, of just under 17%. So in light of the extremely tough conditions, I think it hasn't been a bad investment. Finally, what are we going to do going forward? Well, we've got a strategy that says where and how we're going to look after the portfolio. Further rationalization. We've got too many properties of too small a size. We want to get to maybe half the number of properties, twice the size, something like that. We need to get rid of the negative equity, which we're close to doing. We'll only allocate cash to those investments that will give us at least 10% return on equity. Priority is the silos showing returns, and at the moment that's Cromwell, hotels and Europe. And what we have to do, because the banks are effectively closed in the UK, is find alternative sources of debt funding. And certainly the bond market is one that we're looking at. I know you're using it here in South Africa, and there is a definite opportunity for us there to tap into the bond market. Growth in distributions, I'm asked about that. I think it's going to be inflation plus. I don't know what the plus is, but certainly with inflation running at about 2%, we need to at least beat that. And development gains from the projects that I showed you are going to start adding some profit, and we can recycle that into new income generating assets. So the outlook, the UK is emerging from recession at last. The last quarter was the best growth in about the last 5 years. However, the Eurozone could fracture, but we're in the very strongest part of the Eurozone. We're in Germany and Switzerland, and that's going to remain strong. I think Australia, the worst is over. It seems to have bottomed out, and hopefully we'll get some further growth coming there. And what we have to do, notwithstanding what I told you about there being a lot of assets available, we've got to look for some good assets and take buying opportunities while they're still available. Because if we come out of recession, I think those good opportunities will disappear. And that is my presentation. There's some summary information on the properties which will be available on the website and in your booklets, and I'm happy to take questions.